Welcome back. Welcome to TradingView. Welcome to YouTube. Although I'm having trouble loading it directly onto YouTube from TradingView, I'm going to work on that. And welcome to my Patreon subscribers. How you guys doing? Hello. First of all, thank you very much for my 500th subscriber. As soon as I hit 500, I'm like, oh look, it's 500. Oh, that's great. And then somebody unsubscribed, and I ended up with 499 again. But I did put the 500 subscribers up there. Now I look stupid, but hopefully somebody will subscribe, and then I won't look stupid. But thank you very much. I will continue to work hard to, breach the macroeconomics with the charting and give you the you know the best analysis that I can offer. And of course, I can't get to the point where I'm stepping on my subscribers, uh, you know, analysis. But as much as I can let you know, I will. And again, view this um, as my diary, okay? And you guys get to peek inside of it. These things mean something to me. They're not necessarily of the stock or the forex pair or whatever the case may be. It's important in the overall macro theme of things. All right, so let's get started. I'm going to go a little bit before last Sunday night, and we'll talk about Twitter. Now, remember, Twitter, you can say this is a bullish bull flag, right? It's a bullish 1, 2, 3 down. It did need to complete another wave down for sure, okay, because it was incomplete. This is an incomplete pattern because the count starts from the first counter trend move, right? So here's the thrust up move, and then the first counter trend move is where you start your count, right? So 1, 2, 3 to the downside. It hadn't completed. It was still up in the $64 range. So we're like, okay, look for more downside. It is double topping from back here, right, all the way in 2014. It is double topping. It did find some resistance. So look for more downside. And of course, what happened? Kaboom, right? The whole thing fell apart. So be aware of these things. It might be 2014 or whatever, but remember, price has memory. So that worked out good. Okay. Banking. Okay. This is more regional. KBE is more regional banking. This looks kind of like a, lower high. What did it do? It popped up, but it's still a lower high. Still possible double top here. It's still finding resistance at that previous high set back on March 2018. Okay, so just because it's red doesn't mean like, oh, it's a bad trade. No, you wait for it to break down from this structure and then you take the trade, right? If you're bullish, it's kind of dangerous to buy this breakout here because it's still, it didn't thrust. I don't know. You can do it, of course, but it's not something I would do. All right, here's a big deal. This is a biggie. Um Food inflation and commodities overall are a big deal right now. Again, it's not that they're rising. Okay, sure they're rising, whatever. Okay, fine. The big deal is the speed at which they are rising, and that they're breaking out of structure. That that implies there's going to be more of a run that's going to occur. And if that's the case, it's going to be problematic for people in the supermarket when they come home from the supermarket and they look at their bills. They're going to be like, "What the fuck? I'm paying more," and that's going to create a problem. We also know that interest rates are following commodities up. Okay, so if commodities rise, interest rates are going to rise. Now, why are commodities rising? Well, when you have excessive deficits, you end up in a situation where the money is a one-way street. Once you create it, it ends up in the savings bubble, is what I call it. Okay, in the top 5%, the net savers. It goes into the net savers, and once it goes in the savings bubble, it doesn't come back out. So ideally, what you want savings capital to be flowing back into the functional economy, back to savers, back to the functional economy, back, an ecosystem feedback loop. That's ideally what you want to happen. But that's not what's happening. What's happening is the deficits are funding the functional economy, the productive portion of the economy. And the problem is there that there's drainage that occurs in the productive economy via profit. So think of it like this: income household dis savings equals profit savings. If the profit savings do not feed back into the productive economy and they get stuck in the savings bubble, then you end up in a situation where they're not going to put it underneath a mattress. They're going to go out and speculate with it, and they're going to buy stocks, bonds, real estate, commodities. So it's within this savings bubble that stocks are up, bonds are up, even real estate is up to all-time highs. Eventually, that money is going to overflow into the commodities market. And when it overflows into the commodities market, which is so small relative to all the other markets, you're going to end up getting not monetary, money flow inflation. Okay? It's only because money flows are pouring into commodities that is causing the inflation. It's not that we all have so much money that we're spending that's causing the inflation. Now, this is tricky. Why? Because people are saying, well, look, we just had a 6.4% GDP growth, the fastest in 40 years. Oh my God, this is wonderful. La, la, la. No. If that's the way it worked, then I think we found a solution to growing the economy. We all go on lockdown, we sit home, we get endless of trillions of dollars from the government, and we grow the economy, 6%. You're not that naive to believe that stuff. So obviously, if you're going to compare it to last year when we were on lockdown to this year, and you're going to pump in, $5-6 trillion, you're going to get an effect that's going to look like 6%. The problem is you'll never sustain it. So you come back next year, you show me 6.4% growth rate in Q1 of 2023, I'll be impressed. Then you can start celebrating. Okay. But because we were in lockdown and because we're coming up, because these numbers are skewed, okay, by excessive deficits, by zero interest rate policy, by and endless lending programs from the Fed, by QE, and so forth, people think that it is that we all have so much money that we're creating inflation, and that's not the case. It's not the case. Okay. Another story I heard is, well, it's the supply chains. It's the supply chains. It's the supply chains. Okay, a year later, you can't be saying the same thing. It can't be the supply chains a year later. Are they fully back intact? More or less, yes, but not fully. But that's not what's causing the inflation. It's not. It's just there's excessive amount of savings flowing into commodities. And especially in the late stages of an economy, I'm sorry, of a booming market, what tends to happen is commodities are the last ones to start booming. And once they start booming, it's because they're taking their money away from risky assets into something that's inelastic, like corn, wheat, soybeans, copper, whatever, and they park it there. At the same time, if you're gonna do some infrastructure or something like that, and you're gonna pump more trillions on top of the trillions we already pumped, then of course, the market is going to front run, is also going to go out and buy it for that reason as well. So there's a number of reasons that can happen, but it's not because we're all stuffed with fucking money and we're so rich and and we're going out buying iPhones for everybody like candy. That's not the case. But that's not the way they're going to present it to you. That's not the way politicians want it or incubator economists. They don't want that stuff. So be careful with this commodity stuff. Keep an eye on it. Okay, so China. Big bear flag. Big bear flag. This is the compass again. It's still, trying to figure out what he wants to do here. Again, the likelihood is that this resolves to the downside. It doesn't have to, but that is usually what happens in a big bear flag. All right. So that's not, rocket science. That's straight and forward, simple. So then we did the Sunday night analysis, which was last week. Let's look at Bitcoin. Oh, Bitcoin is going to fall. It's over. Ha ha ha. It's down 20%. Yeah, well, that didn't work out very well. Remember that I came out, I posted this chart, and I said, look, here's a breakout, falling wedge. All right, it had the 1, 2, 3 down. You can see it clearly. Okay, 1, 2, 3 broke out from this structure right in here, and then off it has gone. Okay, so that's very good analysis. That's the way it should work, and that's why I like cryptos. They're not as manipulated. Sugar is sweet. It sure is, right? It broke out, and remember that this was posted back on April 15th, and it says sugar is sweet, and it did break out. Okay, so this is the kind of breakout that I'm talking about. This is the one that's going back to 2011. It's a 10-year resistance area that's breaking, and you know it's going to cause problems for people. I'm telling you. All right, Ethereum. Ethereum. Now remember, Ethereum. I came out 2 Sundays ago and I said, look, don't worry about it. Ethereum looks even finer, right? And there was a 2190 at the time, and now we're almost 3,000. Okay, huge move, huge move. If you allowed people to shake you out, because everybody and their mom was out, oh, it's down 20, 30%. If you allow them to scare you out, then you don't understand how to read a chart. And again, I encourage everybody to first learn how to read a chart that's plain, okay? That has nothing on it. That's the best thing you can do for yourself to improve your trading, okay? Ethereum, Tesla, okay? I got so much flap. Everybody was just flapping their mouth. No, you don't understand Tesla. Tesla has great earnings. It's this, it's that, it's whatever. Yes, but this is a bearish structure. This is that's all I'm saying here. Okay, don't tell me about your fundamentals and whatever cute story you believe in. This is a bearish structure. If it breaks, it's going to fall. And what did it do? Well, there you go. All right, it fell. It dropped. That's Don't tell me in 2 weeks there's going to be earnings call and you'll see. And don't waste your time uh, or my time, please. All right. So this one, with higher commodity prices, dry shipping is on the verge of breaking out into a huge, huge possible move to the upside. It still hasn't done it. It's still kind of stuck there at the 374. It's the third time up. Okay. But look for this one when it breaks out to really start to run. All right. Also, look at Sacos Energy Navigation. It's got a nice little cup and handle formed now. All right, you see the cup. Look at the handle right in here. Okay, you see it? Nice little cup and handle. Again, with commodities rising and money flowing into commodities, these shipping stocks, they're a bottleneck industry, and believe me, uh, they can run. They can run. All right, so here's the big chart. All right, what do we do here? It's breaking out. It's breaking out right here. We got a new high. Now, initially, I said, look for this one to act as resistance, right? Because that's what it's done every other time before. And sure enough, initially we got that pullback, but now it's breaking out. And again, this is a very long term resistance, 13 years. So we break out of here, it's going to run. It's going to run. The FOMO is going to come, and off to the races we go. So be careful with that one if you're short. All right, debt to GDP continues to fall. Okay, don't fall for this. Oh, it's 6.4. Yes, be smarter than that. Amazon, we said look for more upside, and that was back on April 14th, right? And then we're going to look for more downside. And there it is. Boom. Here's the upside, testing the previous high, and now we're going to look for the down move. Is it going to come? I don't know. If it breaks out, you can go long. There's nothing wrong with that. Okay, if it breaks out, take it long. But the likelihood is that based on this structure, it has to correct through time. It's done it before. That's what it usually does. Look at this one, right? It broke the previous highs and then boom, right back down. All right. So it has a tendency to want to pause for a while, and that's okay. There's nothing wrong with that. So that's Amazon, China Eastern Airlines. Okay. So we talked about China. It doesn't look like it's, you know, very bullish. So expect this one to resolve to the downside. Okay. And that's the important thing about of listening to the message of the market, that, you see that the index is not looking very good. So you want to look to see what has a nice setup to the short side. And then when it breaks, you take it. Okay. The probabilities of being right are going to be much higher. Okay. In terms of risk reward, it's much better. How about Russia? Well, Russia has a rising wedge, double top again. Second time it's testing it, maybe third. Uh, so look for this one to move to the downside. Okay, just looking tired. That's all I'm saying. Twitter, we talked about. Okay, double top, and sure enough, it fell apart. And again, a big thank you to all the guys for subscribing. I really appreciate it, and I'm very grateful. And I will continue to work as hard as I can to keep things as simple and as meaningful as I can. Combining charting and macroeconomics. So for the rest of the 3 minutes I have left, uh, if you take a look at the S&P 500, okay, nice big move to the upside. It's going vertical. And that's problematic, believe me. If this keeps going vertical, you're going to end up in a situation where it's going to look something like this. Okay, it's going to go straight up and then boom. So it'll go straight up and then boom. Okay, it does that all the time. Um, Again, look at all the needles that had to pump into the market to get it as high as they did, because prior to that, it wasn't really going anywhere. It was stuck within this big range, going nowhere, and it took endless amount of QE and trillions of dollars in deficits. Just to give you a few numbers, 2008 there was $10 trillion in deficits, and the economy was about 15 trillion in real GDP. Okay, fast forward to today, we're at 28 trillion, so we added another 18 trillion dollars since 2007, and we only got 3 and change trillion in GDP growth. Right, so that's not good. 42% of Americans are making less than $15. 30% of all income today comes from government. These things are problematic. This is they can blow hot air up your wazoo, but we're not headed in the right direction. Sure, market is going straight up, and they want to pump more trillions of dollars, and they'll probably keep going up as long as they keep pumping the savers. But eventually, this is going to end badly. And unfortunately, I see a lot of guys that are gals that are advertising, "Oh, let me teach you how to trade. Oh, let me." They've never seen a bear market in their lives. Right? They never traded a bear market, and some of them weren't even alive during bear markets. But yet they're out there and they're telling you, subscribe to me, do this, and it's like, okay. To me, that's a sign of a top. Uh, there's not too many uh, old timers left that are YouTubing and really caring to teach the new guys what's really going on. Anyway, that's it. Again, thank you very much. I'm gonna talk to you guys soon. Bye bye.